What is going on, traders? In this video, I'm going to lay out exactly what could make the stock market find a temporary bottom and actually rally pretty violently from here. As you know, especially during this time, market conditions, market information, and market data is ever changing, and so is the landscape. And obviously, with the volatility that we are seeing in the market could rally violently for a few weeks, could drop violently for a few weeks. Don't get it twisted, we are still in a bear market, but we are seeing a relief rally here that looks oddly similar to what happened at the end of Q1. But if these following conditions are upheld, I think the rally can actually even be more sustained than that little rally we saw in March. The S&P 500 is back to looking cheap again. If you look at the S&P 500 forward PE, we are currently at the average range at around 16, which is what we've seen for most of the 2000s. So I'm going to get into this in detail for you, as we always do, and tell you what are these important conditions and factors, upcoming events that I suspect will help continue the rally pretty aggressively or stop it in its tracks and push the bear market lower. I'll also go into how we've been creatively investing in this market environment, how we've managed to profit so far for the most part, so that you can do it as well. If this is the first time on the channel, welcome to The Traveling Trader. My name is Z. On this channel, our main goal is to bring you non-BS, concise market updates. Let's get right into it. Now, make no mistake about it, the main issue is still price instability. And until the market is convinced that the Fed actually has a handle on price instability, we will continue to see this type of volatility in the markets where there are relief rallies, more drawdowns, relief rallies, more drawdowns, etc. However, we are now finally seeing a breakdown in commodities. For the month of June, oil has gone down 11%. Lumber is down 17%. And for the first time this year, we are seeing major downgrades on energy and oil stocks. The University of Michigan consumer sentiment also has fallen to a record low, which you might think off of first instinct that is not a good thing, and it isn't if consumer sentiment is low. However, when consumer sentiment is low, that means they are doing less buying, and we are finally seeing potential demand destruction. We also see what is going on in the housing market where there's a major slowdown. So with that said, we might actually see the first signs of inflation peaking. Now, please don't misconstrue what I'm saying. I'm not saying inflation is going away. I'm just saying that it might have found a peak. Whether it stays there for a long time or not is anybody's guess. However, trust me when I tell you that if the next CPI print, in my view, comes in lower than 8.6% and it signals to the market that what the Fed is doing is finally working and that we are finally seeing that demand destruction that the Fed is trying to orchestrate while still keeping us on a path to a soft landing. This rally in the market, this relief rally that we saw this week where the market went up almost 7%, we will likely see a continuation of that rally until at least July 26th, 27th, when we have the next FOMC meeting, where we'll know what they're going to do in terms of rate hikes. I'll talk about that more in a second. And also, we have some of the major mega caps reporting during the summer as well for Q3. This is why in this market, I favored cash secured puts over any investment strategy. And this is what we've done in our elite trading group. I sold cash secured puts on Apple, Microsoft, the Qs, Tesla. You could see how much we're up on those. 25% on Apple, 61% on Microsoft, 52% on the Qs, 36% on Tesla. And I can close these out now if I wanted to, because nobody's going to be able to pick the market bottom. And again, we have these ever-changing factors. The market can go ahead and rally without us. So instead of pulling the trigger and making major buys here and the market heading lower, or just holding on to cash and seeing the market rally without us, you could take advantage of both scenarios by selling cash secured puts. There are too many people waiting for the bottom here, and most will miss it. Mark my words, because that's what happens all the time. So we recently rolled out our brand new platform for the Trading Academy, where members have complete access to all of the courses, all of the Zoom calls that we do, all of the training that we do. You have access to the beginner section, the coaches corner, where you get to ask any question. There is no question that is too rudimentary. You get to chat with thousands of traders about different option strategies. You get to day trade with us on a daily basis. Obviously, the Zoom calls and course masterminds are calls that I direct, so you get to interface with me as well. And if you're trying to learn some of these complex strategies like cash secured puts, or if you're trying to get some of the experienced investors and traders' take on whether a company is solid from a fundamental perspective at this price level, and you want to bounce these kinds of ideas off of each other on a daily basis so you're not going at this alone, to me, it is invaluable. And we're trying to keep this a tight-knit group so that we can provide value to everyone. everybody, you will see a link in the description below where you can apply and talk to one of our ambassadors. All right, so as I said, if CPI comes in lower than 8.6% here, so say we come in at 8%, for instance, and again, if you look at the price of lumber, we are down 17% for the month of June. If you look at the price of oil, for instance, we're going to look at crude oil futures, you'll see that we are down for the month of June 11%. Consumer sentiment is at a record low. If we look at market breadth for the S&P 500, we are finally starting to get green here. Same thing for the Dow. And the NASDAQ has actually been green for a few sessions now, which is why it has seen the most increase, but also contains the highest number of mega cap tech or the highest weighting of mega cap tech companies. But you could see the market breadth start to change finally. Now, please keep in mind that this doesn't mean that the bear market is over by any means. This doesn't mean that the bear market is over. We've seen many bear market rallies. And as you know, the average bear market lasts for almost a year. The average bear market drop in the S&P 500 is 37%. I've gone over those metrics before. And whether a sustained temporary rally turns into an actual market bottom, nobody can tell you, not even me. But in my view, there are conditions here for a sustained market rally. Again, if CPI comes in lower than expected. And we haven't even talked about what if the Fed actually does a 50 basis point rate hike versus a 75 basis point rate hike. It's already crazy to think that the Fed can even start thinking about slowing the roll. But if we see major signs of an economic slowdown, then the Fed is going to be worried more about a recession than inflation. And here's Fed President Harker talking about the possibility of a 50 basis point rate hike for July as opposed to 75 basis points.
If we start to see demand soften, and we are seeing some signs that demand is starting to soften in certain sectors of the economy, and if it's softening quicker than I anticipate, then it may be appropriate to go with a 50. If it's not, then it's probably appropriate to go with the 75. Let's see how the data turns out in the next few weeks.
And you can already see the bond market responding heavily to this. The 10-year Treasury note dropped almost 40 basis points in the matter of a week, meaning that investors are pouring into the 10-year Treasury note, which means that bond investors, at least for now, think that inflation is peaking, because if they thought that inflation wasn't peaking, they wouldn't be pouring into the 10-year treasury yield like this. They would continue to be selling off, or at least holding off from buying the 10-year Treasury note. Now, please keep in mind that a recession is still very much on the table, especially since the Fed funds rate, the effective Fed funds rate, is still negative. This is the Fed funds rate minus inflation. And as the Fed continues raising rates and as inflation continues dropping, this is going to veer into positive territory, which has put us into a recession almost every single time that it went from negative to positive. And also understand that a recession is not a stock market term. It's an economic term signaling 2 back-to-back quarters of negative GDP growth. Remember, the next one comes out July 28th. If that's negative, we'll officially be in a recession. And lastly, as we've talked about before, just because the economy's in a recession doesn't mean the markets won't perform well. As a matter of fact, history shows that recessions are periods where you want to start investing in quality companies that you believe in, because by the time we're officially in a recession, we are closer to a market bottom than a market top. Anyway, traders, that is it for this video. Hopefully you got something out of this video. I know that was a lot to take in. If you have any questions or comments, leave it in the comment section below. I try to respond to every single one. I try to respond to every question. Again, we just launched our brand new platform that I'm super excited about. So if you want to apply to the Elite Trading Academy, link is in the description below. Hit that thumbs up if you got anything out of this video. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.